Hey everybody, welcome to Young Bucks. Really great show for you guys today. Going to continue talking about Qualcomm and why they said no to a bid from Broadcom. We're also going to talk about AT&T and Time Warner and the drama they're facing, read some great Trump tweets, and talk about a major problem that NCAA programs are creating for themselves with coaches. Hey everybody, welcome to What the Buck, the segment when we talk about money. I'm Andrew Hall. Joining me today is Sam Frost, Matt Krebsbach, and Ben Nye over there. No Hat Ben. Welcome everybody. Big show today, so let's just go ahead and jump right in with the my favorite topic of the week, which is Donald Trump with an all-time Trump tweet saying, here we go. Why would Kim Jong-un insult me by calling me, quote, old, when I would never, all caps as you could imagine, call him, quote, short and fat? Oh, well, I try so hard to be his friend, and maybe someday that will happen. So the Asian tour going pretty well. Big takeaway from this is there's a Google Chrome extension that you can download that makes all Trump tweets appear like they're written in crayon, and this one was real good on that. Sam, thoughts on Trump just being a child in general?
I mean, this is what Trump's done since day one. I don't know why this tweet gets any more attention than any other tweet, to be honest.
The most surprising thing to me was that, like, in terms of, like, sentence structure, it's actually pretty good.
Well, that's because they extended the length of the Twitter post from 140 characters.
Twitter couldn't drive daily active users with 120 characters, so they had to expand.
I mean, I don't care what side of the alley you're on this, but, like, that was one of his greatest tweets he's had. That was an all-timer.
An all-timer. Ben's got an update on Trump's draining of the swamp.
Yeah, so he is proposing that Alex Azar becomes the head of the Department of Health and Human Services, which is ironic because Azar was the former head of Eli Lilly, especially the government negotiation division on pricing. So the guy who essentially negotiated for price increases for a drug company is now supposed to negotiate for lower prices for those same drug companies that he wanted higher prices for. So it's a little bit difficult to understand. And unless he's had a total change of heart, which I highly doubt, it seems like Azar will still be for higher prices. And it's a surprise because, you know, this is exactly the type of thing that Trump railed against in the campaign.
No, man, it makes total sense. It's like when they flipped the high-ranking mafia member to make him, you know, basically turn on the mob. So yeah, that's what they're doing here with Azar. Totally makes sense, draining the swamp. Update on the Qualcomm deal. We talked about that last week on Young Bucks, so check that out. I think we also did a podcast on the investing podcast on it, so check all that stuff out, youtube.com/TuskMedia LLC. But Qualcomm has come out, and they've just said, no, we don't want the $70 a share flat out from the Broadcom proposal. Krebs, you got any thoughts on this, man?
I don't think that was surprising at all that they rejected that first offer. I mean, just that's kind of how these things go. I wouldn't be surprised to see Broadcom raise that to 75 and then go through this again. I think that's kind of what the market is thinking anyways, because you see Qualcomm up another 3% today. I think they're trading at $66. So I think it was just kind of, personally, I thought it was an expected part of the process.
Then what does the price have to get to? And we talked a little bit about this in our investment meeting earlier today. What do you think the price has to get to in order for Qualcomm to say yes?
I think it would have to be around 80. I think just that shareholder base, if you're an investor in Qualcomm at like $55 a share, you thought there was substantial value there, like I did. Mm-hmm. And I don't think people will be selling out for less than $80. Because I think the people that are buying it think either one, the NXP acquisition is going to go through, in which case it's worth a lot more, or the Apple litigation is going to fall in their favor, in which case it's worth a lot more. So I think there's a lot of upside there still.
Another deal we've talked quite a bit about is AT&T Time Warner. Seems like the DOJ is, at a minimum, they're kind of posturing, acting like they're not going to let this thing go through. Krebs, I know you have kind of been on this deal since it was announced and kind of our lead here in terms of understanding what's going on. What's your take? Is this something that, you know, is the deal going to crack and just kind of crumble from this point forward, or do you think it's something that's going to get worked out?
I think most likely the scenario in my mind is the DOJ is going to lessen what they want, because they want Time Warner to sell, or they want AT&T to sell Turner, which includes CNN. And then AT&T's stance is this acquisition makes no sense if we don't have Turner. So they're not going to give up much ground. They might give, you know, a few assets here or there just to push it through.
What do you think about this news that Rupert Murdoch's Fox was actually in discussions to buy CNN, or he wanted to buy CNN.
That's where the issue comes. I don't know how that would go through with them having Fox, and then AT&T has nothing, and you're saying I don't want that to go through, but it can go with Fox. That makes no sense. If it actually goes to court, if the DOJ blocks that, they would go to court, and then I don't see how a court would say there's antitrust issues here. I don't see how that would happen.
Yeah, I was going to say, I think...
It'd be a complete waste of taxpayer money.
Right.
I think it'd be ridiculous.
I think the AT&T Time Warner deal has a better shot in the end of going through than Fox buying CNN.
Mm-hmm.
Like, if Fox bought CNN, then we're like, that's fine, but you got to spin off Fox or Fox News, you know?
I mean, now at this point, Time Warner's trading way below that deal price because I think it moves every day because it's partially in AT&T shares. So I think let's just say it's 102. Time Warner's now trading 88. I mean, there's a huge arbitrage opportunity there if you wanted it, which we have.
Yeah. Spoiler. Moving to the important part of the show, football. Man, we've actually got a call out on college football coming up later in this episode. Worst week we've ever had of picks, I think, in the last 2 years collectively. Just terrible updated standings. Ben and I are 28 and 21 on the year. This is against the spread, so we're doing it Vegas style. Garrett also coming in at 28 and 21. Krebs 25-24. Sam 24 and 25. Here is the slate of games that we got this week that we're taking a look at. Wisconsin, a 7.5-point favorite against Michigan. Georgia, a 21.5-point favorite against Kentucky. Washington, a 17-point favorite against Utah. We took out the Bama-Mercer game because there's not a line. So the wild card here is Georgia Tech -6 at Duke. And the bonus game is USC -15 against UCLA. Let's start with Wisconsin. Krebs, talk to us.
I mean, they looked great last week against Iowa, and Iowa's a different team on the road than they are at home, and that was on the road. So I don't give a whole lot of credit to Wisconsin there. I think to beat Michigan, Alex Hornibrook's gonna have to play a good game, and I don't know if he's capable of playing a good game. Kind of like a Jake Fromm situation.
Or Jake Browning.
Yeah. I do think Wisconsin's gonna win, but the fact that we're getting late in this thing and I'm down, I'm picking Michigan because I don't think you guys are gonna pick Michigan.
I definitely picked Michigan.
Yeah.
No.
I've got a mark next to Michigan. I picked Michigan. I have zero faith in Wisconsin in this game. None.
I have Michigan as well.
I've got the Alpha. I have Wisconsin.
Oh, you're Alpha.
I think Garrett took Wisconsin too.
All right, there we go. Georgia, 21.5-point favorite against Kentucky as they try to pick themselves up off the floor from the embarrassment that was last Saturday. I don't think Kentucky's any good. Georgia didn't look any good, but I think they're better than they were Saturday. I'm taking the Dogs -21.5.
I got Georgia.
I did take Georgia.
Georgia.
The thing is, Kentucky's not a bad team. They're at 7-3, right?
Yeah.
I mean, they've beaten the dumpsters of the SEC, but
Yeah, Kentucky does this every year where they kind of get out to a 6-0 start. They don't play anybody, and then
like Vanderbilt.
Yeah, they lose like late in the year to actual teams, and then they usually lose to Louisville as well. So that's kind of what I'm expecting. Washington also trying to rebound, a 17-point favorite against Utah. Ben.
Yeah, I think Washington covers in this game. I think that it's just tricky playing a really late game on Friday night, which is what happened when they went down to Stanford. And now they're back at home, back at the loudest stadium in the history of football, Husky Stadium, and I think they're gonna cover the spread. I don't think they're a great team, but they're gonna cover the spread in this one.
Real quick, Ben, what is the time of week that you would like Washington to play at where they would be comfortable?
I think probably 9 in the morning would be ideal for them. You ask them, it's 9 in the morning.
Got it.
I think I took Utah there.
I took Washington.
I have Utah going against Ben after saying that Washington has the #1 defense in the country last week. So I have to disagree.
There we go. Georgia Tech, a 6-point favorite against Duke. Tech's kind of coming to their own. They're 5-4. They're super obnoxious to play against. Big win against Virginia Tech. I've got Georgia Tech in this game. I just think Duke doesn't have the athletic personnel on defense to be able to stop that option offense. So I got Tech -6.
I know nothing about either of these teams, so Georgia Tech.
I took Georgia Tech as well.
Georgia Tech. I'm even going to give you the score, 9-0.
You're right. Southern Cal, 15-point favorite against UCLA. Ben, I'm guessing you picked this.
Yeah, that was his pick.
Yeah, I think that, this is just an interesting game. You have UCLA where Rosen's completely checked out. You have USC where Darnold is still trying to play for, I guess I don't really know what he's playing for.
He doesn't want to play on the Browns.
But the USC still has a chance to get to the Pac-12 championship game. I think that USC comes out firing in this one, and I think they win by over 20.
I took UCLA.
I've got USC.
UCLA.
Yes. That's
All right,
perfect.
there we go. Jot them down. Check us out. Lots of stuff coming in the rest of this episode. We've got a preview of a conference Ben and I are going to. You guys are going to talk about General Electric, and we also have we talked about Butch Jones, my favorite former college football coach. So thanks for being here. Talk to you soon.
And this interview special this week, we have Vice President of Narwhal Capital Management, Andrew Hall, joining us for an exclusive pre-conference interview. Andrew will be presenting on the topic of reaching millennial clients with millennial employees at the upcoming Schwab Impact conference this week in November. And he's going to be talking about how he reaches these clients. Andrew, can you give us a quick preview of this subject? Because it's something that's in a very new space, obviously, because you're dealing with young people, and a lot of people don't really know how to deal with these young people.
Yeah, and I think that's kind of what we're trying to figure out in a lot of ways here at Narwhal with employees like myself, yourself. It's an interesting topic because it's one of those things where a lot of what I'm going to be presenting is, hey, almost trial and error. I think one of the points I'll make to everybody there is that the outcome would not be that people leave and immediately apply what they learned so much as that they leave and they immediately have discussions about what we discuss in my topic. So the real threat, I think, to people out there that are investment advisors, so on the professional side, is it's really kind of a strong headwind when you start to think about what happens to people who inherit wealth. There's two things that really hurt. Number one, wealth gets destroyed at a staggering pace by second generation and third generation. And the other thing is, if you're a registered investment advisor like ourselves, you have to deal with the fact that statistically 2/3 of our clients who inherit money are going to leave us and they're going to go work for somebody else. So I might have a client that's a $1 million client or $100 million client or whatever it may be. When he or she passes and gives money to their children, most likely those children are going to leave. And so that's what we're trying to address both internally here at Narwhal, but also through this talk and try to encourage people. It's kind of a weird thing in that you don't want to show, the playbook, so to speak, because on one hand it makes it sound like you know all the answers, and on the other hand is if we do know all the answers, we don't necessarily want our competitors to know them. But there's enough to go around in this industry that I do want to encourage people that are thinking about it the right way to, have some opportunities to do it.
Can you tell us a little bit about how you're different from other speakers on this topic? Because I think everyone has their own idea about how they think they can access millennials. How are you a little bit different than that?
Yeah, that's a great question. And I think, it's always, when I say different, I wouldn't say I'm better or worse. It's just unique in that I am a millennial and I am an investment advisor. I've heard a number of people speak at previous industry conferences, some even at Schwab Impact, this event itself. And those are actually the people that kind of inspired me to go after this because I didn't think I could actually get it. But part of why I was inspired to do that was there's kind of two buckets of folks that it seems like you hear from. One is the person that is maybe from a psychology or sociology background that's an expert on young people. And I'm not saying that sarcastically. They know a lot about young people, but they don't know much about managing money or managing wealth, financial planning, topics like that relevant to what we do every day. And then the other is a lot of times you have these young people who are kind of trying to be wealth advisors, investment managers, however you want to term it, and they've not had a whole lot of success and they've almost gone into maybe a consulting role or things like that. We're kind of living proof that, no, you can hire young people to make investment decisions, and I do think that's incredibly unique. In fact, that's how the talk's actually going to open up, just talking to the audience, which should be north of 100 folks there. Don't know the final count or anything like that. But one of the things we're going to be doing is just right off the bat, doing a little show of hand exercise and figure out who all works in an office in which the majority of employees are young people under the age of 30, 35, and are actually letting those young people make investment decisions. And there's just not many people doing that. So I think we are unique as a firm in that we're doing this. You're making investment decisions for clients that you're the lead on, Ben. I'm doing it for clients. We're working cooperatively with people like Sam, Matt Krebsbach, doing things like that. We're letting people like Greg make movies, all that kind of stuff. So I think we're, kind of uniquely positioned there.
And just with respect to millennials in general, are they actually important to an organization? Because there is a perception out there that they are lazy, they're entitled, and they struggle to communicate.
Mm-hmm. Yeah, I think some of those perceptions are there for a reason. I think some of that is true. I think where millennials thrive is when they're in a scenario in which they can both learn and contribute. And I think finding that balance is really, really difficult, especially in a results-oriented business like our own. We're reviewed every quarter by every client. We're reviewed by other people in our office constantly. So finding that balance and the way to motivate and engage young people is a challenge, but I don't think that's necessarily unique just to millennials. I think that's always difficult with people that are in their 20s or early 30s to figure out how to motivate them. We hear a lot that, millennials don't know how to work. We've had a lot of millennials through these doors, either that are currently working here or came through as interns or came here in full-time capacities and moved on to other ventures for whatever reason. We've never had an issue with them, quote unquote, not knowing how to work. And so I think that's a huge misconception. And I think, honestly, that's just kind of a lazy excuse for people who don't really want to figure out what it takes to get young people in their office.
And just lastly here, we are a bit of an unconventional office, and we do things a little bit unconventionally. So as our maiden appearance at a conference, are you planning anything that is a little bit different? Any surprises that we should be looking out for?
One big surprise. Stay tuned. We're actually going to take this topic, which again is reaching millennial clients with millennial employees, and for about the last 90 seconds of it, we're going to throw it out the window because we're going to be in a room full of investment advisors, people that make investment decisions on behalf of clients. And the last minute and a half, 2 minutes of my time, we got 60 minutes. The last little bit there is actually going to be me pitching an idea. It's an idea that we own in several client portfolios and one that I own in my portfolio, so it's actual stock. And maybe we'll give that pitch next week. I know it's actually a stock we've talked about before on this show. But so we're going to kind of do that just with the hopes of, hey, hopefully there's a lot of discussion you can have based on the topic itself, but maybe there's 2 or 3 people that actually walk away with an actionable idea for a client portfolio.
From a millennial, no less.
No less.
So stay tuned for that. We'll be tweeting about it, blogging about it, and we'll come back with a full recap on Young Bucks next week.
There we go.
Hey everybody, welcome to an educational segment. Name of the segment pending. I'm Sam Frost. This is Matt Krebsbach. How's it going?
Not bad. How are you?
Going well. So we're here to talk about GE. GE's been in the news a lot lately, and not for good reasons. It's been I think the definition of a dumpster fire since for this year really. They've really struggled, and GE's finally kind of trying to take steps to turn this thing around. So far this year, they're down almost 40%. Today, they were down over 7% alone. Trying to make some changes. So the new CEO steps in. You had Jeff Immelt, old CEO. He's out. He stepped down, I guess, a couple months ago. New guy, John Flannery, and he's here to make changes. Krebs, what you got?
Yeah, so a lot of investors have been waiting for this investor day. I mean, today's Monday, so the investor day just happened today. A lot of people have been waiting on the sidelines, us included, not really knowing what to do or make of the company until you see like a vision going forward, because there are very significant issues with the company, strategically wise. Just touching on the high points of what that investor day came to be, they cut the dividend in half, which is staggering. I mean,
big cut.
Last time I did that was in 2008, and I mean, it was kind of priced in for the most part. I think the dividend cut was priced in. I think pre-market it was trading up, actually,
right.
Believe it or not.
But that's still a huge thing. A lot of investors look to GE for the dividend yield.
A lot of retirement people holding on to that for that 4.5% dividend, just massive. But now you're back down to, what is that, 2.25?
Yeah, and correct me if I'm wrong, y'all Google this, but I'm pretty sure Immelt made a comment saying that the last time he cut the dividend back during the financial crisis, he said it was the worst day of his life.
Yeah, GE touts that dividends are a priority and everything, but company sustainability should be the priority. You also had the board of directors at 18 members. That's cut to 12, which I think is a very underrated move. I think that's a crucial move. I'm very glad they did that myself. I think just a lot of wasted money and a lot of wasted time there listening to 18 people talk on a board of directors. And then for earnings guidance, they cut their 17 adjusted earnings to around $1. I think $1.07, I want to say, around there. Maybe
fiscal year 2017.
Yeah, 17, and then 18 was a little lower than that, believe it or not. So that I think you can just pencil in for 18. They're guiding about $1. I think that they're probably sandbagging all that stuff. They're not going to give guidance on a day like this where they knew they're probably going to get smashed market wise they're not going to give bad guidance and not beat that bad guidance.
Right.
You know?
So down, like we said, about 40% this year alone, when the market is, I don't know what the S&P is up right now, maybe 15%, something like that. And so is this a buy opportunity for GE? Should investors be cautious? What do you think?
I still think it's really hard. Like if you have a long-term horizon, probably. Are you going to make money by next year? I don't know. Probably not.
Yeah.
Maybe not.
Yeah.
But I think like GE is such a complicated company. There's so many segments, and one of the things they're trying to focus on is selling off everything that they're not the best in. And what they're the best in is aviation, making jet engines in power, which hasn't been the case, but that's what they want to keep. They know that's going to be great if they can figure out, make that more make that cash flow better. And then the healthcare segment, those are the three main pillars that they want to build GE on. But today they have locomotives, which isn't that good. But then, so you have locomotives, and then you have oil and gas,
Yeah.
which, I mean, that's just oil and gas is a cyclical business. I think they made the right move in merging with Baker Hughes. They probably overpaid for it, but I think the rationale behind it was smart. I mean, you merge with Baker Hughes, get the synergies, and then it'll be an easier way to sell off when it's a publicly traded thing. You just own the equity interest. Their strategy of selling those off might be the worst thing to do. You know, selling off, that was the issue with Jeff Emmett. Like, he sold off all these businesses at the peak, or at the trough. I mean, so they're getting like bottom dollar on all these businesses. I'm worried that could be the case with this new strategy. But to your question, is now the buying opportunity? If you have a long time horizon, I do think so.
Yeah, and I agree.
But that's the key there.
I think you got to have a long time horizon. You know, we actually just talked about this in our investor meeting about, is this a buy opportunity, is this not? And we ended up not pulling the trigger. You know, the catalysts are that, like you mentioned earlier, Flannery knows he can't come in and cut guidance to, what was it, $1 a share for EPS roughly. He can't come in and give that kind of guidance, that kind of cut from what it used to be, unless he's 100% sure that they're going to have that. And so, and I would think that the market's probably pricing that in, even trading at $19 a share. They're pricing in the fact that they have to have that in the bag, that they're going to get that. And so, you know, it might not quite be as cheap as you think. You know, another catalyst.
That's the key.
Right. And so that's what one of our other analysts actually said today. Their PE went up after selling off 7%. Or maybe not today, but since they cut the EPS guidance.
So, I mean, just comparing it to like other multi-industrial companies, it's still, even using the 18 estimates of $1.105, let's just go with the $1.105, it's trading at a discount to all these other peers. But I think with GE looking out 4 years, 5 years, do they have the like top line growth potential that their peers do? I don't know if they do. That's my issue.
Yeah.
'Cause I think they can figure it out. I think they will figure it out. They have pension issues, but I think they'll figure that out as well. But can they get back to the growth with those segments of 4-5% top line growth? That's not an easy task.
And so, and something you got to keep in mind is you have these huge segments that you can sell off that typically are catalysts, but they have, you know, a lot of debt that they have to, interest payments they have to make, the dividend payment, even though they cut it, is still a large payment. They got to keep generating the cash flow to keep making these payments. And, you know, the kind of final thing before we wrap up, we often talk about how it's easy to fall into a trap when a company gets crushed. When their share price drops, you know, they report earnings, they drop 20%, and people want to say, oh, they're cheap. You know, they got sold off. It's way overdone. One of my fundamental beliefs is that when a company gets rocked, it's tough to value that company. So much has changed. And you kind of touched on this. This is a huge ship. To turn this ship around is going to take time. And so this is an investment that you want. You got to have a long time horizon. You know, and yeah, like, so maybe in 5 years, this turns out to be a great investment, great buying opportunity. But it's going to be rocky, I believe, in the short run.
The thing, Jeff Emmett tried to turn the ship around. Like, that's what a good part of his tenure was, and it just didn't work. So, I mean, if you're buying GE, you have to be very informed of what Flannery's doing and accept and say, this, I agree with these moves. That's the key if you're interested in GE.
Exactly. Well, there you have it. GE, be cautious. Got a long time horizon. Maybe it's a good time to jump in, but it's going to be we think, in our professional opinion, it could be a little bit of a rocky ride. Stay tuned. We got more coming.
Hey, everybody. Welcome to the Call Out. This is a segment in which we call people out for making really bad financial decisions. I'm Andrew Hall, and today we're going to talk about a topic that's near and dear to my heart, and that's college football. We mostly talk about college football when we do the What the Buck segment, And you know we're pretty good at this stuff. We're all above 500 against the spread and making our picks, so we're kind of experts on that topic, along with being experts on the topic of money. Today we're talking about good decision, bad decision, coaching buyouts. Now, if you're familiar with college football at all, you know coaches make a whole lot of money. It's not uncommon to see a coach of a large public university be one of, if not the highest paid employee in the state. Kind of a weird imbalance, but that's where we are in the state of college sports. It is a business. It's not just about student athletes, folks, believe it or not. So these people make insane amounts of money. Nick Saban, the coach of the University of Alabama, highest paid coach at $11 million. You could argue that he's actually underpaid relative to how much revenue that sport actually generates in Tuscaloosa. So these guys are making a lot of money, but today we're going to talk specifically about Butch Jones. Butch Jones was just fired out of the University of Tennessee. I grew up hating the University of Tennessee, so I really loved having Butch Jones there because he was kind of a disaster. He started there in 2013, quickly turned a Tennessee program that was just 5-7 in 2012 into a 5-7 team in 2013. Now I didn't misspeak. He didn't improve. They went from 5-7 to 5-7. So that's why he makes the big bucks. 5-7, 7-6, eked up to 9 in 4 years. He was famous for saying all kinds of neat little phrases like, we're going to build this thing brick by brick. They never built it above 9 wins, so never really got there, never won a division title, even in the weaker division of the SEC. He was, however, as he claimed, champions of life. So he's making a whole bunch of money to be champions of life, and he recruited a lot of people with 5-star talent, but even more people with, quote, 5-star heart. So that's the kind of guy Butch Jones was. Kind of a disaster of a year for him at Tennessee. Last year was supposed to be the year. They finished 4-4 in conference play. Didn't win the East. This year they were 4-6, and he was let go. Last little tidbit about Butch, other than the money stuff, is Butch actually has an active losing streak against every team in the Southeastern Conference. So name an SEC team, and Butch lost at least the most recent game against them. So that's a pretty impressive streak right there. Butch Jones was making $4 million a year, 4.1. What's wild is he just got paid $8.1 million to not coach football. That's what a buyout is, folks. He gets paid all this money to not coach football. They basically have to buy him out of his contract. There is some offsetting language there, so if he gets hired somewhere else, Tennessee can reduce the burden that they owe him. But it's a crazy thing to pay somebody $8 million to not do something. I've actually been doing my darndest to get fired from the Young Bucks show and see if they would pay me my existing salary to not come on, and they actually said they would because I don't make money. But if I was making money, there's no way they're going to say, you know what, Andrew, we normally pay you $100 an episode. We're going to give you $100 to not be on this episode. It's a really weird paradigm. So why do colleges do it? For the most part, what they're trying to avoid is a scenario in which a coach gets there, gets some momentum, and then jumps ship, and in doing so, blows up the recruiting trail, that pipeline of getting young talent. It goes away because the coach leaves and stalls momentum. But what's interesting is that there's rarely a time in which this is even for both the school and the coach. So in Tennessee's instance, one of the 5 or 6 highest grossing athletic departments in the entire country, this should be a dream job. A rich tradition, won a national championship in 1998. Perennial SEC power, at least until about 10 or 12 years ago. This should be a dream job for most coaches. So a scenario in which they're thinking, hey, well, Butch Jones, who's previously been at powerhouse programs like Cincinnati and Central Michigan, this might be a stepping stone gig. If that's how you're viewing someone like Butch Jones, you're probably coming at this from the wrong approach to begin with. And it can create some really weird imbalances. So yeah, you're paying Butch Jones $8 million to walk away. You kind of have to do it because he's a disaster for your program and you're losing fan support. What gets really interesting is when these really elite programs, like say a Florida State, have down years, because Florida State is 3-6. They were a preseason top 5 team. Maybe Jimbo Fisher, the head coach there, is on the hot seat, or maybe he's not, because to get rid of Jimbo Fisher, they'd have to pay him $39 million. That's not a misspeaking right there. $39 million to make Jimbo Fisher go away. Really odd paradigm. Then you have guys like David Shaw at Stanford, who I think actually would be due potentially for a quote-unquote better job, at least from a traditional standpoint, and he doesn't even have a buyout. So go somewhere, David. Like, go get a different job. You could probably go to a more powerhouse program, or Gary Patterson at TCU. No buyout. So these things are kind of all over the place. If you're Nick Saban at Alabama, you're probably not going to get fired anyway because you're the best coach in modern college football. And if you're Alabama, maybe it makes sense to pay him to not leave. But so often we see these huge insurance clauses in place to protect these guys, and it creates an odd system. You've got a guy like Tom Herman, who went from Houston, head coach there for only 2 years. Previously, it had only been an assistant coach. Now he's at Texas, which, again, should be a top 5 job no matter what the era, no matter what the stakes. Huge recruiting ground, huge budget, huge history. He's doing okay. They're 5-5, but if they want to get rid of him, they got to pay him $20 million to walk away. So buyouts, rule of thumb, real quick. If you are an employer, if you are doing the hiring, don't give anybody a buyout. It's going to hand strap you. You're not going to be able to make free decisions. If you're an employee and you can get a buyout, take that thing and don't do a darn thing, because that's kind of what it seems like Jimbo Fisher's doing. It almost seems like he wants to get bought out for $40 million. There you go. That's the call out. Calling out university athletic departments and poor decision-making in contracts. Really the big winner on this. Sometimes it's the coaches. It's never the university. More often than not, it's the agents. So shout out to the agents out there getting their hustle on.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.